Disclaimer, this is an educational case study and qualitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, let's get right into it. Welcome to This Explainer. Today we're putting a fascinating player in the global oncology market under the corporate X-ray. We are talking about BeOne Medicines. This is a company that's rapidly transitioning from its scrappy startup origins into a mature, highly profitable global enterprise, and we are going to dig through their recent filings to figure out exactly how they're pulling it off. Okay, look at this number. $1.7 billion. That is the top-line revenue BeOne generated in just the second quarter of 2026. This isn't just a big number in a vacuum either. It represents a massive 30% jump year over year. For a company operating in the highly competitive, heavily regulated pharmaceutical industry, achieving that level of top-line growth at this kind of scale, well, it's a clear signal that their commercial strategy is firing on all cylinders. Section 1. Meet BeOne Medicines. The hook and history. So to really grasp how they pulled off that $1.7 billion quarter, we have to look in the rearview mirror for a second. They started back in 2010 as BeGene, with a dual founding in Beijing and Cambridge, Massachusetts. By 2016, they hit the NASDAQ with their IPO. But the real inflection points, those are much more recent. In 2024, they underwent a strategic rebranding to BeOne Medicines. And then 2025 was the absolute landmark year. They hit their first profitable year with a massive $5.3 billion in revenue and simultaneously moved their headquarters over to Basel, Switzerland. They've systematically engineered themselves into a borderless global oncology leader. Section 2. Q2 Financial Breakthrough, the engine driving growth. Now, this is where we roll up our sleeves and dig into the financials. BeOne didn't just edge past the street's expectations this quarter, they absolutely crushed them. They reported an earnings per share of $2.05, easily blowing past the consensus estimate of $1.40. Their free cash flow essentially doubled year over year, hitting $435 million. As an analyst, I love seeing that because it proves their growth is actually generating cold, hard cash, not just paper profits. They're operating with a gross margin near 90%. But the undisputed heavyweight champion here is Brukinsa, their flagship blood cancer drug. Out of the $1.7 billion in total quarterly revenue, Brukinsa generated $1.25 billion entirely on its own. And you know what's even more telling than a Q2 earnings beat? It's how management adjusts their forward guidance. They didn't just take a victory lap. They significantly raised their full-year targets. They bumped their total revenue expectations up to a range of $6.6 to $6.8 billion. And even more critically, they raised their GAAP operating income target from a ceiling of $850 million all the way up to $1.1 billion. That kind of upward revision reflects immense internal confidence in their commercial momentum for the rest of the year. Section 3. Global Footprint and Workforce. The people powering the pipeline. You don't hit these kinds of elevated financial outputs across 45 different countries without a massive operational engine behind you. According to workforce intelligence data from Revelio Labs, BeOne employs over 12,000 people globally as of March 2026. That is an enormous headcount for a company that was technically a startup just a little over a decade ago. Managing an infrastructure of 12,121 people requires incredibly sophisticated operations. And it's fascinating to see exactly where that talent is distributed. Geographically, almost 60% of their workforce is still firmly rooted in East Asia, which makes sense given their historical roots. But notice that 21% of their talent is now based in North America. That highlights a very aggressive, very deliberate operational push into the U.S. market. Section 4. Expanding U.S. manufacturing, capital investment in North America. Speaking of that North American expansion, let's talk about CapEx. To support this growing strategy and meet surging demand, BeOne is sinking $300 million into a massive, purpose-built small molecule manufacturing facility in Hopewell, New Jersey. It's almost 145,000 square feet. The key takeaway here is that they are designing this facility from the ground up to meet stringent FDA requirements from day one. This is a highly strategic capital allocation aimed at localizing production for their most critical markets and, frankly, de-risking their global supply chain. Section 5. Market and Analyst Sentiment. Wall Street's reaction. Okay, let's put our skeptical analyst hats on for a second. We've got two very different signals to weigh here. On one side of the ledger, we have strong bullish sentiment from Wall Street. Analysts hold a moderate buy consensus. Firms like TD Cowen have cranked their price targets up to $454, while Guggenheim is pointing to $430. But on the other side of the ledger, we always have to watch the insider activity. We see planned stock sales from executives, including the CEO, offloading over $44 million worth of shares through a prearranged 10b5-1 plan. We also see the COO and CFOs selling shares, though primarily to cover tax withholdings. It's a classic juxtaposition. You've got external cheerleading from the street, balanced against standard internal corporate liquidity mechanics.
Section 6. The Road Ahead. Synthesizing BeOne's Trajectory.
So, putting all the pieces of this puzzle together, the cash flow metrics, the CapEx data, the analyst reports, we are objectively looking at a company aggressively maturing into a powerhouse. The data points to incredible short-term acceleration. I mean, a 30% revenue jump, a massive U.S. manufacturing build-out, and a drug like Brukinsa basically printing cash. But it leaves us with this final thought to chew on. As their footprint swells past 12,000 employees and they saturate their existing markets, will this explosive momentum become their permanent new normal, or will they inevitably face the margin pressures and growing pains of a legacy pharmaceutical giant? The street is pointing one way, but the corporate mechanics always warrant a closer look. Which side are you on? Do your own homework. Thanks for diving into this explainer with me, and keep questioning the data.